Welcome, everyone. Thanks for joining us at this high-level panel session on central banking after the pandemic, the challenges of inequality and inclusive growth. As we all know, the pandemic has exacerbated the challenges associated with economic inequality and has raised awareness of the role of macroeconomic policies in promoting inclusive growth and mitigating inequality. And although fiscal policy may be the main avenue for dealing with these challenges, the role of central banks has recently come into focus. And we have seen, especially since the global financial crisis, how much central banks can do and have been doing to support the economy and various economic objectives beyond delivering price stability, which is a primary objective for all central banks. So the topic of this panel is to discuss the role of central banks can play in growth, reducing inequality. We only have a short amount of time. It's less than 60 minutes, and we have three very experienced panelists with us. I will ask each panelist to give brief introductions, 10 to 12 minutes. The three panelists are Jim Bullard, President and CEO of the Federal Reserve Bank of St. Louis, and member of the Federal Open Market Committee on this side of the Atlantic. Then we move to the afternoon time zone, where we have Olli Rehn, Governor of the Bank of Finland and member of the Governing Council of the ECB. And then we move towards Asia, where it's late at night right now. We have with us Zeti Aziz, former Governor of Bank Negara, Malaysia. And we're so grateful for Zeti for being the sole representative of the emerging market economies in this debate, so we can compare notes. I will be moderating the discussion that will follow the introduction. So I invite members of the audience to post questions, and with the limited time we will have, I will draw from those questions for the discussion we will have after the introductions. And without further ado, I'm going to give the floor to Jim Bullard, then Olli, then Zeti for their introductions. Jim, the floor is yours.
Great, thanks very much, Athanasios, and thanks to the other panelists. I'm looking forward to the commentary here on monetary policy and inequality. I have a slide deck. I'm not going to go through every single slide, but I thought it would provide an outline of my thinking in this area. I called this, while we're waiting for the slides to come up, I can tell you a little bit about it. I called it the nexus between inequality and monetary policy. We can go to the next slide. And the next slide. So the key question here is whether can monetary policy be conducted in a way that benefits all households, even in a world of substantial heterogeneity? And the basic answer here is going to be yes. If you don't want to listen to the whole set of remarks here, the basic idea is that the established academic advice to monetary policymakers, which is to try to establish and maintain the Wickselian natural rate of interest, continues to hold in an economy with lots and lots of inequality in consumption, income, and financial wealth. So let's go to the next slide. This is based on a paper that I wrote with Ricardo Di Cecchio, who's also at the St. Louis Fed. It's called Optimal Monetary Policy for the Masses. It is a DSG model, includes lots of interesting features, but I'm not going to go through most of the details in this talk, but if those that are interested can check that out. Let's go to the next slide. So the main argument is that there are some fundamental drivers of inequality that are not really in dispute in the literature. One is the hump-shaped pattern of productivity over the life cycle. So it is going to be a life cycle model. That's an important contributor. And then within cohorts, there are different levels of education for households within the cohort. That's going to generate lots of inequality. The households, however, whether they're rich or poor, will need to use credit markets. There's a credit market friction in this model. The central bank can overcome that nominal friction. And there's a welfare theorem that states that the allocation of resources that results is first best. Let's go to the next slide. So I have just one slide on the environment, the next slide. So just to level set people, this is a general equilibrium life cycle economy. That means that a new cohort of households enters the economy every date and another cohort exits. They make decisions over 241 periods. So it's a quarterly model. It's meant to address business cycle issues and monetary policy issues. Preferences are simple. The key to the model is that households are assigned a personal productivity profile when they enter the model. And I'll talk about that as we go through this. And then they can sell their productivity units on an open market at the competitive wage. If they have more productivity units, they're going to be better off. If they have less, they're going to be worse off. Let's go to the next slide. So the next slide. So when households enter the economy or agents enter the economy, they're already 20 years old. So what we have in the model is some kind of random process that is a stand-in for the human capital development that takes place before age 20 in actual economies, including schooling, parenting, and any pre-age 20 job experience. So you come in, you're age 20, I just hand you a life cycle productivity profile, which is a proxy for all that stuff that isn't in the model. Huggett, Ventura, and Yaron famously argued that differences in initial conditions are more important than differences in shocks for lifetime earnings. They said that the bulk of lifetime earnings can be explained with a vector of attributes of relatively young workers. So we're going to do an extreme version of that. You just get the one shock at the beginning of the life cycle, and that's it. Let's go to the next slide. So here's a typical baseline productivity profile. The average value is 1 here when you're young, and 0 to 60 here in quarters. You have relatively low productivity, and then you have higher productivity in the middle and lower productivity at the end. The difference between the high and the low here is only about 50%, but that's enough to generate substantial income inequality, as we'll see. Let's go to the next slide. The baseline productivity profile then is multiplied by a random draw from a log normal distribution. In this picture, it's from a uniform distribution. That gives you this blue mass here. So some people got the blue line multiplied by a relatively big number. They're on the upper end here. And other people got the blue line multiplied by a relatively low number, and they're on the lower line. So this is going to generate plenty of intercohort differences in income. Let's go to the next slide. So next slide. So the key things about if you calculate the general equilibrium here with the aggregate shocks, you get this picture, which is the blue line, shows how much people are going to work at each point in the life cycle. They aren't going to work very much in the beginning or toward the end, but they'll work a lot in the middle. That's the main point of this. The red line is the 19%. That's the value of market time in the data across all workers that is devoted to market work. So the people in the middle of the life cycle are above that. This line is the same for all workers, rich and poor. So surgeons work a lot in the middle of life, but so do taxi drivers. Everyone works on the blue line at the different points in the life cycle. Let's go to the next slide. And so the key to this whole exercise here is that not only are you more productive in the middle of life, but you also work more in the middle of life. So this generates lots of income in the middle of life and not very much income at the beginning or the end. So this is what the labor income mass looks like at any point in time. And we're going to calculate the Gini coefficient of this, and it's going to be close to the data. Let's go to the next slide. And how much are they going to consume? Well, they want a smooth consumption over the life cycle. So they're going to take that income that occurs in the middle of the life cycle, and they're going to try to move it to consumption at the beginning of the life cycle and the end of the life cycle. So that's the red box here. They're going to use credit markets to do that, and it's going to all work out perfectly in this particular model here. Let's go to the next slide. So that what they're going to do is the middle-aged agents are going to lend to the young agents. So the young, relatively young on the left-hand side are going to be net borrowers, and on the right-hand side here, they're going to be net lenders. So the asset holders in this economy are going to be the top half of the age distribution, which is what it is in the US data. We're going to calculate the Gini coefficient of the right-hand side of this picture, and it's going to be pretty high. Let's go to the next slide. So next slide. So if you calculate those Gini coefficients, we've got the US data across the top here and the model across the bottom. Without doing very much work here, we already got Gini coefficients are very close to the data. So if you did more intensive exercises here, it would be easy to get the Gini coefficients right. Let's go to the next slide. So next slide. So what's the point of this? Well, the stylized model can do other things, and I send you to the classic policy benchmark paper or slide deck here. You can add unemployment risk. You can add taxation to fund a government. What you would need in those cases is a labor authority that runs an unemployment insurance scheme and a fiscal authority that collects the appropriate taxes. But none of that changes the recommended monetary policy. Let's go to the next slide. So this model can generate lots of inequality. But the bottom line is that there's a correct real interest rate nevertheless in this economy that the monetary authority needs to achieve. All these households need to have access to the credit market, and they want to get the proper interest. They want to be using the proper interest rate in that credit market, which is the Wickselian natural rate of interest, the same one that would occur if there weren't any frictions at all in the economy. Let's go to the next slide. So this all sounds very esoteric, but there's practical policy characterization here. The policy that's recommended out of this model is a version of nominal GDP targeting, which is closely related to price level targeting. Recent changes in US monetary policy via our framework review announced last year have actually moved US Fed policy closer to this ideal. Let's go to the next slide. In the model, productivity over the life cycle plays an important role in determining income and financial wealth for different households at a point in time. In addition, household earnings are shaped to a large extent by human capital accumulation before age 20, which is before entering the model in this setup here. In the classic policy benchmarks deck, there is an education authority which can control the dispersion of the beginning of life cycle human capital, and that would change the Gini coefficients. So that's an interesting area for further research. Let's go to the next slide. And in this picture, I just want to focus on this to finish up here. This sigma on the horizontal axis is the amount of dispersion within a cohort in their education levels, and the green line is the consumption Gini, and the blue line is the income Gini, and the red line is the wealth Gini. And our calibration is the black vertical line there. But you can change the within cohort dispersion, the sigma, and move it out to the right, and you'll move all the Gini coefficients up toward 1 if you do that. If you move it all the way down to 0, which would be a perfectly equal society, you see that the consumption Gini goes all the way to 0, but the income and wealth Ginis do not. You'd still have income inequality of a 0.44 on that Gini coefficient and a 0.65 on the wealth coefficient. So this says that a lot of the observed Gini coefficients are actually life cycle effects. Let's go to the next slide. And the final slide. So what we're saying in the paper with Ricardo De Cecchio is that observed levels of U.S. inequality are due to life cycle effects in conjunction with within cohort heterogeneity. But all households in this model, regardless of who they are or what their economic characteristics are. They want access to the credit market to be able to smooth consumption over the life cycle. There is a credit market friction in this model, and the monetary authority can remove the impediment to life cycle consumption smoothing for all households. So it's a version of optimal monetary policy for the masses. So I'll stop there, and I'm looking forward to the discussion. Thank you, Athanasios.
Thank you, Jim. And with no further delay, Olli, the floor is yours.
Thank you, Athanasios. Dear colleagues, dear friends, it's indeed a great pleasure and honor to participate in this panel and to have a chance to address the CEBRA annual meeting today. I have just returned from Frankfurt to Helsinki. Some hours ago, we had a two-day meeting of the ECB Governing Council, and we concluded our strategy review. So I am currently in a self-imposed voluntary quarantine at the home office, and I hope that the connection works. I also hope that there will be we will not be too much disturbed by possible noise of helicopters. Don't worry, they are of the Finnish army. I happen to live quite close to the garrison area in eastern Helsinki, and sometimes we have this kind of disturbance here. I will focus on the euro area viewpoint in my initial remarks and start with the economic outlook, which is always critical for inclusive growth and questions of equality, inequality. Euro area GDP is rebounding strongly this year. However, core inflation, excluding energy and food prices, is expected to rise only slightly from 1.1 to 1.4% by 2023, as euro area domestic cost pressures such as wage inflation are projected to recover only gradually, but still remain muted. Importantly, the medium-term inflation outlook is still below the ECB's 2% symmetric inflation target as defined today by Christine Lagarde. The policy response to the crisis has been quick and forceful across a broad front in Europe, including the ECB's very accommodative monetary policy stance. And we continue to stand ready to adjust all our instruments to ensure that inflation moves towards our aim in a sustained manner in line with our commitment to symmetry. So how does monetary policy then relate to the issue of inequality? As is well known, income inequality has been rising for several decades in most advanced economies, more in some, less in others. There are some common drivers, including globalization and skill-biased technological progress, as well as country-specific factors, of which the changes in taxation are probably the most important ones. We know that monetary policy impacts inequality through two main channels, the income and wealth channels. Concerning the income channel, it is critical to note that the wages and employment prospects of low-income households are typically more sensitive to business cycles, and therefore monetary policy easing by stimulating economic activity and thus assisting in saving and creating jobs and increasing wages does reduce income inequality. And this has been the main effect after the previous crisis and in the present crisis. On the other hand, households' business and financial income are more responsive to monetary policy than their labor income, And this impact of the income channel in monetary policy easing tends to benefit wealthier households more than low-income households. As to the wealth channel, monetary policy easing generally makes the life of borrowers easier, but can impact negatively on whether of households' savings. However, the overall net effect depends on the composition of household balance sheets. A fall in the interest rate affects different assets and liabilities in a different way. Now, what do empirical studies say about this? Several studies have concluded that the overall effect of unconventional monetary policy measures on income and wealth inequality is rather limited. Overall, the easing of monetary policy has assisted in diminishing inequality in recent years in the euro area, especially via increased employment for lower income households. After the global financial crisis and the euro area debt crisis, 12 million jobs were created in Europe by the COVID crisis, and monetary policy significantly contributed to that progress. Furthermore, the cooperation between monetary and fiscal policy in the crisis response has helped to reduce long-term job losses and bankruptcies, and thus contributed to the overall well-being of the public. Looking at my own country, Finland, monetary policy has not played a significant role in the evolution of income or wealth inequality. Forthcoming research by the Bank of Finland staff suggests that the transmission of monetary policy to households with different types of wealth and income profiles is rather similar to that observed in other countries. Monetary policy easing seems to reduce unemployment most among low-income households, while also boosting the general wage level, which benefits proportionally more high-income households. Similar effects have been found out in studies in our neighboring Nordic country, Sweden. In fact, considerations about labor income and wealth inequality do strengthen the case for a lower for longer strategy when monetary policy is constrained by the effective lower bound. This is, to my understanding, in line with the considerations that featured prominently in the Federal Reserve's recent framework review, and have contributed also to the new ECB monetary policy strategy, of which President Christine Lagarde informed the public today. So before concluding, let me ask, on the basis of these reflections, what should one, as a central banker, think about inequality and inclusive growth in the making of monetary policy? Of course, we work on the basis of our mandate, which is price stability. But in Europe, the EU treaty implies that we also take into consideration full employment, balanced growth, and sustainable development, as long as it does not compromise price stability. In my view, the philosophy of John Rawls is a most helpful guide here. One of John Rawls's key insights, or one of his 3 principles of a just society, is that inequalities are acceptable only in case that they benefit the less well-off members of the society. That is by no means a carte blanche for instance, advocating tax cuts that benefit the richest, or believing in some trickle-down theory of economic growth. But it does imply that as the main impact of monetary policy in the proximity of effective lower bound has been to raise output and employment, and thus reduce income inequality by helping create millions of jobs and enhance the income of the previously unemployed and other less well-off, even if it had limited negative side effects on wealth inequality, then the policy has been in line with the pursuit of a just society. And I can say I'm a Rawlsian in this regard. So, dear friends, time is almost up. To conclude, central banks must better understand how income and wealth inequality impact the transmission of monetary policy, and take that into account in our monetary policy making. The greatest contribution central banks can make to the society is to deliver on their price stability mandate, since this will also contribute to broad-based, sustained and inclusive employment growth. I'm confident that the outcome of the ECB's monetary policy strategy review will enhance the effectiveness of our monetary policy, and thus also support the attainment of sustainable growth and full employment. Let me finish here. Thank you for your attention, and I look forward to our panel discussion and your possible questions.
Thank you, Olli. So it's so refreshing to hear both from you and from Jim how central banking has changed. I recall when I was a young economist at the Fed, mentioning that employment is part of the Fed's mandate was considered problematic and out of bounds in terms of communication. And here you talk about the secondary mandates of the ECB. Again, it reminds me, not that long ago when I was participating in these meetings at the ECB, it was not considered appropriate to mention that the ECB had a secondary mandate. So we've come a long way since then, which is a very good thing. So
evolution is possible.
Indeed. So Zeti, we turn to you to get to learn from the experiences from your long career at Bank Negara, but overall your perspective from the emerging market world. Floor is yours.
Yes. Well, greetings from Kuala Lumpur, and thank you for the invitation to participate in this meeting, in this panel. And my remarks will be from the perspective of an emerging economy. Most central banks in emerging economies actually have multiple mandates. And in addition to the monetary and financial stability, there's the mandate to develop the financial system, to develop its markets, the payment system, and the financial infrastructure that would best serve the economy, and to promote a balanced and inclusive growth that is sustainable. So in the aftermath of the pandemic, central banks will transition into a significantly different environment in which the economy and its functioning will be significantly transformed following the disruptive consequences of the pandemic on consumers and businesses, and the more accelerated technological developments and digitalization will all change the environment for central banks significantly. An inherent aspect of central banking, whether from developed or emerging economies, is a longer-term orientation of its policies. And this is a marked contrast to other entities that operate in the economy that are more focused on the immediate term outcomes. The first challenge confronting central banks as the pandemic recedes is that policies will need to shift from providing relief and life support and keeping the economy afloat towards the recalibration of the policy mix during the crises to longer-term policies to address the fundamental structural issues, amongst which is the topic for our panel, rising inequality. My remarks today will consider 3 points. First, the grounds for which central banks need to be involved in the drive to address inequality. Second, to discuss the manifestation of this inequality and how some of the trends might have been due to unintended consequences of policies. And third, to discuss some of the policies that have been pursued by central banks in emerging economies to address the rising inequalities. Studies have shown, and this is also for the developed economies, that rising inequality is that it has been a factor that contributes to compressing aggregate demand. As a redistribution of income occurs, and as the concentration of income accumulates to higher income groups that generally have a higher propensity to save, this may eventually become a constraint on growth. The compression in consumption for the lower income groups, either due to their lower wages to begin with, or due to job losses during this period. As consumption spending moderates, this in turn erodes the incentive for businesses to invest and expand their capital stock in the economy. Such demand, slower demand over an extended period, should over time affect the expansion of the productive capacity of the economy. And the slowing of consumption demand that relates to low wages earned is a major issue that needs to be addressed. And in emerging economies, low wages also relates to the low productivity levels. Another aspect that is particularly pronounced in emerging economies is the income disparities that arise from the income derived from capital and the income earned by labor. And this is, of course, true also in developed countries, but it's probably more pronounced in emerging economies. And the divergence has become increasingly more pronounced. Capital income, however, is concentrated amongst the top 1% or even 5%, while labor income is earned by the majority. So during the periods of stock market rallies, unrealized capital gains contribute to significant increases in wealth for its shareholders. But if this is not translated into higher consumption demand, which in turn does not stimulate new investment activity. A further motivation for pursuing the agenda of the goal of achieving the addressing inequality is achieving the S in the ESG. Very often we talk about the E and the G, but the S is equally important. It is about economic well-being of the overall population. This is to bring meaningful value of progress to society as a whole. And this is to secure the economic prospects of every segment of society. This is considered pivotal to a sustainable future. Finally, it is the recognition of the need to invest for the future so that the agenda of sustainability can be realized for our future generations. While the major reason for this growing income disparities is low income earned by low wage workers in emerging economies, as I've mentioned, is also to increase the productivity levels and to adopt greater leverage of technology to achieve greater levels of efficiency. There's a need also to root out corruption, which is also incurs a cost to society. These disparities are also due to the different sectorial performance in the economy. For example, the disparities between industrial and agriculture sectors and the real estate and property sectors, and the financial sectors, where the wealth is concentrated amongst a few of these dominant sectors. Then there's the differential that exists between rural and urban incomes. And more recently is the emergence of the urban poor, particularly following the pandemic. It has been made more pronounced. Amongst the factors that contribute to this differential is the differential access to financial services, to education, and to health care. Finally, it is also the access to infrastructure that facilitates the necessary connectivity to enhance the potential to benefit from the increased opportunities. There's no shortcut solution for addressing rising inequalities and the goal of achieving inclusive growth. The management of associated challenges mentioned is not confined to any specific authority. It calls for collective efforts amongst multiple agencies and authorities. Pivotal to this then is coordination to achieve the wide range of objectives mentioned. And this is true in emerging economies. For better wage and compensation for workers, for example, it's not just about measures to increase levels of efficiency and productivity. It is about labor reforms. It is about having better access to financial services, education, and health services. Central banks in most emerging economies have significant role in addressing this access to financial services to bring lower income groups into the financial mainstream and hence into the economic mainstream. This through greater outreach, including through leveraging on technology, and then by encouraging the development of financial products that meet the requirements of this segment of the population, and then making it simple and easy to understand, meeting the requirements of security and safety, consumer protection, and thereby build confidence in participating effectively in the financial system. I just wanted to mention an example in Malaysia because there's one unique aspect. We have established 3 institutions over a number of decades ago, and this provides small savers with access into capital income. This includes our Employees Provident Fund that now manage equivalent of $250 billion US, and PNB, where I spent some time as well, that is a mutual trust fund that manages about 80 billion equivalent US dollars, and Tabung Haji, which is a pilgrims fund that manages 20 billion, where the funds are invested in domestic and international capital markets. And this provides an opportunity for small savers to invest in such capital markets, which on their own, they would never have an opportunity to do so. And the central bank actually was involved in establishing these institutions, and also some of them come under the oversight of the central bank, whereas another the Securities Commission. Most central banks in emerging economies have also had an important role in strengthening financial literacy and for more effective participation in the financial system. And in the recent decades, the high penetration of the mobile phone has led to greater leverage on new technologies with the use of the mobile phone to facilitate financial transactions and the conduct of commercial activities by small businesses. From the region that I come from, work is in progress for greater financial integration within the ASEAN region, and to generate a consumer market that is for our region that covers 630 million people. So let me conclude with a few remarks to say that while central banks have an important role in bringing about inclusive growth, it is the collective action of multiple agencies in the country, and therefore there needs to be, the central bank needs to have effective interface with the other agencies, and there needs to be also, however, boundary management with having clarity of what the central bank will do and what it will be accountable for, and having clearly defined governance arrangements for effective management. And finally, also, there needs to be clarity in the inter-agency relationships, procedures, and protocols. These institutional arrangements need to be established for the effective coordination, and countries in different parts of the world have addressed this in different ways. Clarity in outcomes to be achieved, with clarity in responsibilities and accountability, and the governance arrangements that is reinforced with a high level of transparency. And this is achieved, of course, with communications. Within this arrangement, central banks' independence can still be left uncompromised. And this is particularly with respect to its traditional mandates that are well defined and conducted with a high degree of transparency within a governance framework, that the independence of the central bank will remain uncompromised. When we have independent central banks, it means that we have central banks that we can believe in to deliver long-term goals, and that policy objectives will be achieved within these arrangements. Thank you very much.
Thank you, Zeti. So it's, you brought a very different perspective to the discussion. And what I would like to do is give each of the panelists the opportunity to comment on what you've heard. But in doing that, I will also pose a question that came from the discussion. Hearing Jim and Olli, the focus was on what monetary policy can do in order to reduce inequality, and we've heard some of the considerations there. Listening to you, Zeti, I take into account the fact that other policies that central banks can contribute to may be equally important, and in some cases, perhaps even more important. Financial inclusion, education, making sure that lower income households have access to credit and financial services. And these are issues that are, of course, relevant not only for emerging markets, but also in advanced economies like the United States and in Europe. So I wonder if I can get a reaction from Jim and Olli on this one while they're reviewing this, as to what is it that central banks can do, like the Fed or the ECB, outside monetary policy to address these issues, and whether these things can be done in the context of the current legislation, or whether they would require changes in the law, as was mentioned, are available in some emerging markets. So Jim, let's start with you. If you would like to offer your views, and then we can go to Olli, and then we'll go back to Zeti for her comments on the remarks.
Thanks very much. So on the question of other possible avenues, the Fed does do this, and all the Federal Reserve banks do have, for instance, community development programs and programs that are directed toward financial inclusion. Some of that is in partnership with the banking sector. Other parts are in partnership with nonprofit organizations. So we are trying to push ahead on those types of issues. However, it does not cross over to monetary policy itself. As I outlined, I think that the recommended approaches to monetary policy that are coming from the academic literature, which are to make sure the credit markets are functioning as best they can function, because everyone needs them to be functioning well in order to get the best allocation of resources. That has to be the focus of monetary policy. I think also, higher inflation tends to be not very good for the low end of the income distribution. At the low end of the income distribution, you have more intensive use of cash, and to have higher inflation is going to be eroding their savings and their balances on a daily basis. So that isn't going to be very good for them. So I think you have to keep that aspect of the distributional consequences in mind as well. I think it's an important aspect of what the central bank does is to try to make sure there's financial inclusion across the society. If somebody's excluded from financial markets, then moving interest rates around up or down is not going to affect them because they've been excluded. So I think sometimes there's a little bit of confusion around that okay, we should pick a particular interest rate setting because you're gonna help people that are excluded, but the people that are excluded are not the credit market users. So I think it is incumbent upon us to continue to advance the cause of financial literacy and financial inclusion. We've tried to be a leader on that at the St. Louis Fed through our economic education program and other programs. And so I guess we're doing what we can. I would say one other thing about this. I have found the business community to be exceptionally interested in financial literacy and very willing to push the agenda forward on this. They definitely have the view that there isn't enough financial literacy in the economy, and we could do much better if we were all better up to speed as a society on financial matters.
Thank you, Jim. Olli, would you like to offer your remarks?
Thank you. I try to be brief. We have an active role, as Jim said, concerning the Fed and the St. Louis Fed. We have also very similar active role in promoting financial literacy and inclusion in Finland. And that is quite typical of the Nordic and other European countries. It is a major challenge as we are facing digitalization in several ways. One is that, let's say, for younger people, there is no physical budgetary constraint like for us when we were youngsters, because the banknotes are not the critical thing in your wallet anymore. It's the mobile payments. So that calls for new standards of financial literacy in a way. On the other hand, we have to also defend cash because as 80 or 90% of the people pay either by mobile or card payments, and only maybe 10-15% use cash nowadays as their primary means. They still have the citizen right to use cash, and we have taken some role in that regard. Concerning how to tackle inequality, I would refer to what Zeti was saying, that there are several authorities and we need a division of labor. It's mostly the responsibility of fiscal policy in the national context, often of the labor market or social partners, trade unions and employers organizations. And in Europe, typically, it is mostly national policies that determine labor market outcomes, such as the employment rate. Having said that, yes, monetary policy can support full employment without prejudice to price stability. In the presence of a flattened Phillips curve, policies that are aiming at full employment are likely to have a moderate inflationary impact in the short term. And under such circumstances, monetary policy can also help us get closer to full employment. Thank you.
Thank you, Olli. Zeti, would you like a brief response or added comment?
Well, there's one issue, of course, that is discussed openly from time to time during periods of very low interest rates, where financial markets have really rallied, and this creates wealth for the higher income groups that own stocks and shares and have stakes in large corporations and in the financial services. And this contributes to increased disparity. So there is that linkage between monetary policy and creating more pronounced income inequality. But the point that I didn't mention in my remarks is something else that's quite relevant in environment where there's financial stress being experienced. And in many of the emerging economies in Asia, I know that I'm familiar with, that we have the Corporate Debt Restructuring Committee for those corporations that have huge debt obligations. And but over and above that, we have such debt restructuring for small and medium scale enterprises, and we have debt restructuring for households as well. And we found during the Asian financial crisis that this was very effective in preventing foreclosures and bankruptcies and so on, that helped to reduce this from happening, not just with the big corporations, but also with small businesses and in households.
Thank you, Zeti. Thank you all of you. So from the questions that I see in the panel and from the remarks that you made, one issue that has come up that I would like to poke a little bit further is the following. You have all mentioned that one of the most effective ways monetary policy can help address the issue of inequality is to respond effectively during downturns, lower for longer, making sure unemployment does not stay high for long. This is the income side, the aggregate demand boosting side. But there is also the asset boosting side of monetary policy. And one of the things we have seen, especially for those central banks that have been hampered by the zero lower bound, is the tension between the two. Depending on how monetary policy is implemented, it can boost aggregate demand directly through investment, through consumption, or it can boost asset prices and then indirectly through a wealth effect affect the aggregate demand and improve the economy. And of course, those two channels have very different distributional consequences. They relate to the choice of, is it appropriate to be boosting housing prices, for example, specifically through the pari-passu mortgage-backed securities in the US or covered bonds in the euro area? Isn't this affecting only a fraction of the population, whereas other policies might be more widespread and equal? And the question I would like to pose to all three of you is, given that there are alternative ways to boost aggregate demand in fighting a recession, to what extent does the role of these choices on inequality play a role in selecting the policies? Would one policy be avoided because it would raise inequality and another policy be preferred because it reduces inequality? Is that a consideration that we now actually see in practice in thinking about monetary policy decisions? I'm addressing this to all three of you so that you have the choice to respond. But if you prefer, I could say, well, we can talk about MBS for the Fed. We can talk about covered bonds for the ECB, if you prefer to do that, or other implementation policies.
So I can start if you want.
Sure.
Okay. So traditionally, the Fed has had the idea of market neutrality, and many central banks, I think, have tried to go with market neutrality, that you're trying to operate in markets in such a way that you're easing overall financial conditions in the event of a negative shock to the economy, and tightening them in the situation where inflation is more of an issue. And I would say that the GFC, the global financial crisis, was a novel situation for the Fed, where this was coming from problems in housing markets and mortgage markets in particular, and that led us to expand our purchases of mortgage-backed securities and related assets. We actually had done a little bit of that before the global financial crisis, but we obviously got much more into that. And the rationale at the time was that this would help housing markets recover. Lots of controversy around whether really made that much difference at all, because it wasn't that clear that the mortgage-backed securities were all that different from Treasury security, especially medium maturity Treasury securities. So, I think as a matter of general practice, however, at least for me, I'd like to see the Fed get to something that was, again, based on market neutrality to the extent that we can do that, which usually in the US has meant stick with Treasury securities in the portfolio. The committee has said at various times that it wants to get back eventually to an all Treasuries portfolio. We're not in a position to do anything like that right now, but I think longer term, that would be the objective. Another thing for the audience here to just keep in mind is that in the US, the Fannie Mae and Freddie Mac, which are the main agencies that are purchasing and holding mortgage-backed securities, they're in conservatorship still. And the federal government is really running those. So it's you might just say, well, those are government paper as well. And so in that sense, maybe we still are market neutral. So there are lots of issues around this, but I think this principle of trying to have the broadest impact across all markets is the best one for the Fed.
Thank you, Jim. Would you like to give us your European perspective? Olli?
Yes, thank you. I think this very much relates to the discussion on side effects. And I recommend you to read not only the two-pager, or as Christine Lagarde said, it's one sheet of paper, 2 pages retroverso, so one sheet, which is our new monetary policy strategy statement. But in addition to that, we published today also a 15 or 16 pager, an explanatory memorandum, which includes analysis and discussion on both the main effects, which I think are always important to underline and keep in mind, and potential possible or realized side effects of monetary policies. And on these, we know that there are effects, side effects on inequality. I discussed that in my initial remarks. I don't repeat that. There are effects on financial stability. We take these into consideration, but our yardstick, our criterion is in line with the EU treaty, price stability, and we formulate our policies on the basis of our new strategy, which provides a revised definition of price stability and a revised definition of our inflation target, which is clearly 2% symmetric inflation target, supported by a reaction function, which may imply that we temporarily have inflation higher than 2%. So that's the basic strategy, and then we have different policies to supplement this macroprudential policies, which probably should be used more actively in Europe and elsewhere in the world. We are trying to do that in Finland on our part, and also issues of redistribution, but those are mainly to the fiscal policy makers and in a way social partners as well. So just to finish, I think it's important to recall the main effects that this monetary policy has an effect on price stability and can have effect on output and employment. And this is the critical thing. This is the core effect. And if you are criticizing side effects, or if somebody is criticizing the side effects and would say that because of those we should also take away the main effect, then I recommend thinking about the counterfactual, which is a wave of bankruptcies and mass unemployment, which we would have faced unless the central banks had taken very rapid and forceful action of monetary policy accommodation.
Thank you, Olli. And Zeti, if you would like to contribute to this discussion, I will invite you to do so. But I will note to all three of you that unfortunately we are running out of time. So I will give Zeti the floor and give the opportunity to Jim and Olli to respond as well for a minute.
I just wanted to add that policies in emerging economies as well, I should say, that it is decisions are based on market neutrality as well. And however, we started using macroprudential measures in the 1990s, but we weren't clever enough to call it the macroprudential measures, but essentially they were. And therefore, it limited borrowing, for example, to participate in the stock market or in real estate speculation and so on. These macroprudential measures were used quite extensively in the mid-1990s. And they are very effective to reinforce and prevent these side effects of monetary policy. In conclusion, I would just say that this is an area that central bank needs to participate in, and if the clarity of outcomes and the governance arrangements and the level of transparency, I don't think the central bank position will be compromised, and the central bank will contribute to the greater good of achieving sustainability in progress and development. Thank you.
Thank you, Zeti. Jim, would you like to give us a 1-minute summary in your final remarks?
Sure, thanks. I would just say to the researchers out there that I think macroeconomics is in a quandary here about what to say about inequality and monetary policy. You do hear thrusts, and some in this panel and elsewhere, that go in different directions. Some people say low interest rates increase asset prices, and this benefits the asset holders in the economy, which in my graph would be the older segment of society. But other people say that low interest rates helps the lower end of the income distribution by changing unemployment dynamics and boosting growth to the economy. So I think we need to get clarity on which one is it? The low interest rates helping poor people, or low interest rates helping rich people? And I think there's a powerful argument on both sides, and we need models that will help disentangle that.
Thank you, Jim. And this indeed relates to what Olli mentioned earlier about the main effects and side effects of monetary policy. And indeed, in the policy discussions, we hear views on both sides. So absolutely, the researchers listening in can help us improve our models and give better advice. And Olli, your final minute remarks.
I was about to say the same as Jim, but maybe in different words. I would join him in this regard because it is of immense importance that we would have more analysis, also empirical analysis on these different effects. And I think this discussion has actually shown that we have across the world, both in the advanced economies and emerging economies, and hopefully re-emerging economies like Finland one day. So we have both similar and different challenges, and this field of central banking and therefore of central banking research is today at a very exciting phase, and it's very meaningful to do research in this area. So I hope that you will have time to study our conclusions of the strategy review, and I very much look forward to comparative studies of that in the coming years. Very much look forward to that. And thank you for this discussion to my colleagues and to you, Athanasios.
So thank you, Olli. Thank you, Jim. Thank you, Zeti. It's such a short time to discuss the issue. So I guess I will end by reiterating the point that was just made. This is a session at the Central Bank Research Association, and this is an area where, again, speaking from my experience, it's so refreshing that whereas 20 years ago it would have been off limits for most central bankers in most countries to be talking about how to promote inclusiveness and how to reduce inequalities. Right now, this is on the table, and this is already a big improvement relative to what we have. But our models are not really there yet. Very few models can help contribute to this discussion. My understanding of baseline models that are employed for policy purposes in central banks, most of them cannot really treat inequality. There are few counterexamples for that, and this is a call for the research community to help us give better advice to all involved in policy, striving towards better economic policies and better outcomes going forward. So thank you very much for attending the panel, and thank you very much for the panelists for your participation. Thank you.
Thanks, everyone.
Thank you. Bye-bye.
Bye-bye.
Bye.